Good morning, everybody. I'm Jacques Bolivar, Certified Financial Planner. Also today will be with me Shane Barnard, State Attorney. Good to see you, Shane. I'm going to speak about life insurance. It's an integral part of personal finance. In our practice, we do money management, financial planning, insurance brokerage, and we're going to focus on insurance. I'm going to go ahead and share my screen. And so as we think about life insurance, we're going to make a presentation that really focuses on why you should consider buying life insurance. How do we in our practice determine the need for someone that's a client, how much insurance they should have, and what are some of the reasons that people are considering life insurance during the various stages of life? And to understand how we use life insurance, we're going to talk about how these contracts are built. And within that, we'll also talk about some of the other living benefits that assist you with some of the potential risks in a long-term financial plan. So when we talk about reasons to buy life insurance, it comes up really when families, individuals are thinking about protecting their loved ones. And if we begin with the premise that we could have our working years be 35 years if we start working early in a late high school or college, and then work until Social Security begins at 62 to 67. And so that's a pretty long time that we anticipate to work. And we also then have the potential for 30 years of retirement. So these are a lot of years and a lot of potential income and wealth generation. So when we think about life insurance, it's a contract. And it's a contract between a policyholder and an insured. And the thought is that the policyholder pays a premium in exchange for a lump sum of money to come to you if you have a mortality event. And mortality events are determined primarily based on your age, but also underwriters evaluate your health to determine if they should charge you more or less. If you're an Olympian-like insured, or you an unhealthy smoker and have to pay 20% more. A lot of times people think of the couple here in the photo when they think about why to buy life insurance, but sometimes you want life insurance as an individual as well, or if you have a blended family. And what you're trying to protect is your equity, your wealth in your business, maybe replace income. And if you also maybe make an appreciated stock gift for tax reasons, but you want to replace that loss of that gifted money, you use life insurance to fund to a charity and replace the income to your family. And so we'll talk about these various things from the perspective of how do you think about life insurance in the various stages of life. And so as I was saying, in the early years, you have so many years to work ahead of you. Life insurance is about replacing income. So the thought is if I predecease my family or my business partner, what promise do I want to deliver? And life insurance provides that money to fund that promise because you're not able to earn that income over a lifetime. Later in your middle years, it might be about protecting your mortgage. And many times people are spending upward of 35 to 40% of their earned income on the cost of having a house. And that is a substantial expense that children and grandparents don't want to be uprooted if you have a mortality event and you leave them without enough income to afford that home. So it's a form of mortgage protection. Think of it that way. A lot of our clients are thinking about it for business reasons. If you're in a small business and you have two partners and each person has a different expertise, you're two lawyers, two general contractors, and you want to make sure that the business continues if one of the partners continues on. Each partner buys life insurance. A lot of times we see that there's buy-sell agreements between business partners, but they haven't taken the time to fund that buy and sell if there was a mortality event or a disability. And so life insurance can help with that. Sometimes in businesses, we have key employees, and we want to make sure there's continuity in a business, and we don't want to have the loss of an employee. Many of you who work with W-2 jobs may already have some form of key employee insurance. When you have 5 times, 3 times your salary, it's helpful for your family. And sometimes they may offer additional amounts if you're an executive. These are forms of key employee insurance. We also sometimes have contracts that if we lose a contract, lose business, and we don't want to sell hard assets, we need liquidity in the event of mortality, life insurance funds that. We'll also talk a little bit about how life insurance is used to not only provide benefits for a mortality event, but is a form of addressing the what ifs in a financial plan. What if I'm disabled? What if I have chronic illness? We'll spend a little bit of time talking about that as well today. And then if we talk about another phase of life, thinking of yourself as an empty nester, right, retiree, we think of insurance for accumulation of wealth. Certain types of insurance provide for the ability for a tax advantage accumulation of wealth. When we talk about the construction of policies, we'll get into the function and how this is constructed in the contract, and then we'll show you where it's relevant to use accumulation in either your middle years or your pre-retiree or retiree years as a tool and one of the many buckets of money that fund for your income replacement in retirement. We'll have questions at the end if any of you think of some things about insurance that you want to ask a little bit later. One thing that we talked about was the living benefits. It's really clear that, and I want to point out when it comes to chronic care, that the underwriters haven't done a really good job with long-term care in the insurance industry from the perspective of it's been around for about 35, 40 years. Life insurance has been around since the early 1700s. I think actuaries know how to price and get that right. But we really have kind of a crisis in the insurance industry where, in the case of long-term care, quite frankly, underwriters didn't expect people to live as long, linger, have to deal with illness for so many years that they didn't price right. And so I'll explain later how we're using life insurance policies to protect against long-term care because the traditional policies are unaffordable right now in the industry, and we don't even have a lot of insurers. It's almost like thinking of having so many fires in California, and it's difficult to get fire flood insurance right now. It's difficult to get long-term care, a quality long-term care insurance policy. So the best way that our practice finds that we're providing these benefits are through accessing the survivor benefit in life with a contract that has riders on it. We'll also, like I said, we'll go into the cash value accumulation features of insurance as well. So next, I wanted to talk a little bit about the types of insurance. So then when you think about the different phases of life where you want to protect loved ones or business partners, you can understand how to use life insurance as a tool. So the first type of insurance is term insurance. The second type is permanent insurance. The difference here is term insurance is a contract between the insurer and the policyholder for a finite period of time. And because that finite period of time is typically during those years that you're least likely to have a mortality event, it's inexpensive. And it functions quite like car insurance in that if you pay a premium and you have an accident, you get paid a claim, in this case, the survivor benefit. But if you don't have a death event, there's nothing paid out and there's nothing to show for it afterwards. Okay. And that's why I mentioned here that there's no cash values associated with it. Whereas with a permanent policy, it's intended to eventually pay a claim. And because of that, it has higher premiums. These premiums can be flexible, and there's cash value accumulation because insurance is like a forced savings plan in those years that the cost of insurance is cheap. you're saving for the event when you're in your 70s and 80s that it's much more expensive than your premium. You've been forced to save in advance to be able to afford that policy. Okay. In a moment, we'll get into detail about how that works. So, term insurance, I'm using this graph here. We have a survivor benefit. Let's say you have a loved one that you want to provide protection for $1 million. A lot of times people ask me, well, Jock, how do we assess the need? Well, in a financial planning practice, we assess the need for life insurance through cash value financial planning. We try to understand that your income, your expenses, and project forward and say, if one or both of the loved ones in a family die, what happens to those survivors? And would life insurance be an efficient tool? So in this case, we might say the insured is earning $100,000. It's a good benchmark if you're not doing financial planning to say you need 10 times your income in life insurance. Now, obviously, a full analysis would give you, more or less based on your individual situation, but just as a benchmark, that's usually in the early stages of life a good way to determine how much you should have. So that's $1 million here, SB, survivor benefit. And you notice that the COI, the cost of insurance, is rising over time. That's because from the early days of life insurance, when in England they had mutual membership organizations that were, ideally providing for widows and children, each member would pay a premium, and if there was any deaths among the members, and they would pay out a claim, and those members that were older paid more. And obviously you pay more as you're older because you're more likely to have a mortality event. And underwriters have a profession as actuaries with the very purpose of making the calculation of what's that risk, what is that COI line. But when you're into a contract for a term policy, you pay a level premium. That's basically the present value of all of those COIs over multiple years. The graph here is for 30 years. It's because most contracts, 95% of the contracts I see are for 30 years or less that are term contracts. Again, it's inexpensive because it's ensuring you in those years you're least likely to die. Now, a permanent policy, we introduce this bucket, and everything else is the same. We have $1 million survivor benefit. We have a premium, but this time the premium is a little higher on the chart. And you notice that gray area here on the left. This is the premium funding the policy, but it's substantially greater than the cost of insurance. That's because of this forced savings feature of life insurance. The insurance company puts your money in a bucket, and that bucket is then a forced savings plan to fund those later years, your 70s, your 80s, when the likelihood of death is much greater and the costs are higher, that you have enough money to afford to maintain the policy and eventually get your $1 million survivor benefit. Now, in a nutshell, it's more expensive because you're protecting this $1 million potential payout for more years. But what happens is you have this cash value, so you have the ability to then do other things with it. And so when we talked about your middle years, we talked about retirement, and it can be an accumulation vehicle. You don't just have to participate in the forced savings program. You can also enjoy some of the benefits of the bucket of money here by taking some of the money out. Now, what's very important to understand is if there's 10 things that you can do to support your financial independence, put money in a retirement account, invest in a second piece of real estate, et cetera, et cetera. This type of program is not the 1st through 6th step that you would take. It's the 7th or 8th or 9th step. Why? Because it takes a long period of time to realize the ability to benefit in this way, of what I call a Roth-like experience, fund the money with after-tax premiums. It grows in the cash value with tax deferral, and then you pull it out tax-free. This Roth-like experience takes many years to bear fruit. So a lot of promoter of these programs promote it as step one, and then it doesn't work out because you don't have proper cash reserves. You're not pulling from other investment sources. So it's a misuse of a strategy. When it's a complementary strategy in conjunction with 6 other things, it should not be the sole retirement strategy. Okay, that's important to understand. The other thing I wanted to share before we get into questions is many people say, well, how is it that you get this Roth-like experience with taxes for life insurance? And the answer is life insurance, as long as you're not deducting the premiums, has always, since the 1700s, been a vehicle that is tax-free when you get that survivor benefit. Now, South Africa, UK, they may have some other tax situation for life insurance, but that's been the case in the United States since the beginning. And what you do is you take money out up to the premiums that you funded, and to the extent that you take out more than your premium, that is treated as a loan against the policy, a loan that is paid off upon death. So that is important to understand, but it also means if we go back to looking at your planning, we need to plan for what is the protection for the income replacement, and what are you doing otherwise when you start to use it for accumulation, because you need to make sure all the features are working in conjunction. You don't want to take too much out. You don't want to leave too much in. You want to plan ahead. So again, this is why it's step 7 through 10, possibly, of a good financial plan. It's not one of the first things you do. It's a complicated strategy that requires servicing and touch. The last thing I want to say about permanent insurance, you may have heard many phrases to describe insurance: whole life, UL, IUL, VUL, all these different types of insurance. They're all forms of permanent insurance. They all intend to pay out that survivor benefit. But what is different about each is who bears the risk of return within the bucket, the cash reserve. So if the insurer, the corporation paying the survivor benefit, carries all the risk of what happens in that cash reserve and guarantees you a return, that's a whole life policy. If there's some combination of sharing of risk of that rate of return in the bucket between the insured and the insurer, that's an IUL policy or a UL policy. And if the insured is the one bearing the risk of the rate of return, and the insurer is guaranteeing nothing about how well this grows, and you want to invest in the stock market in your cash reserve, that's called a VUL, a variable universal life policy. Okay. So with that, I'm going to open it up to questions, and this is my contact information. Anybody wants to reach back out to me, have a one-on-one meeting. I'm going to open it up in the chat, ask you to put chat questions in there. I see a hand raised for Aviva. I'm going to ask you to unmute yourself and go ahead.
Thank you so much. Thanks for that presentation. I have a question, but first, can you repeat what you said about repaying the debt?
So the way that you keep withdrawals from a life insurance policy tax-free is that the first lot of money is the return of your premium. There's no, typically in any investment type of scenario, when you're returning your original investment dollars, it's called basis. You don't pay taxes on that. So then the question becomes, any money above your basis, any money that you receive above and beyond what you put in premiums into the policy, how is it that it's not taxable? It's because the insurance company treats it as a loan, and you're repaying the loan upon death. So think of it this way. If any of you have ever had a 401k loan, if you're my client, you know I haven't advised you to do that, but folks may be here that have done that. When you get that 401k loan, your employer doesn't have you pay taxes on that withdrawal of money. It's a loan against the 401k, and you pay yourself back. And as you pay yourself back, there's no 1099, there's no taxable event. And so think of it, it's just like that with life insurance. It's not taxable because it's a loan. It's not a withdrawal.
Okay, thank you so much for that clarification. And in terms of the survivor, is that named or is it just next of kin? So like, let's say my husband and I die in a car accident, but I was the survivor. I was, would it automatically go to the insurance payout automatically go to my kids if I have that in my estate plan?
One of
Or
the simple features of a life insurance policy is the beneficiary designation. So when Shane gets into her presentation, she's going to talk about probate. And so when we think about probate, the state of California's will for you, if you haven't put one in place for yourself, a beneficiary designation supersedes that. It is predetermined when you apply. You're going to say, I first wanted to go to my spouse, and the successors are my children. That's going to be pre-established, and nothing will change that. The money when we're dealing with wills and trusts and the aftermath of passing, the first money that you typically see going to beneficiaries are life insurance proceeds because they have beneficiary designations. And once the insurer sees a death certificate, that's all they need. End of story.
But can I jump in?
Shane, go ahead, jump in.
Yeah, my understanding though, Aviva, if your husband has a policy and you're the survivor, right? You're the beneficiary of that, and you both pass, it does not go to your children, right? The life insurance policy is only for those that are named, unless you name your children as the contingent or second beneficiaries in line.
Yeah. So if you make a decision today and you want to change it later, the insurance company is only going to look to what is in writing, right? So this is something you need to revise and review and come back to periodically. Now we have a question from Portia. Between whole life, IUL, and VUL, how do we decide what is best? Okay. And I think what I would like to do is come back to the assessing potential risk chart, Portia. And what I'm going to say here is this: if you don't want any ifs, ands, or buts about paying that survivor benefit, a whole life policy, the insurance company is putting themselves fully on the hook. And so that's very good. But when you bear the risk and like you have a VUL, if you don't fund enough or the stock market doesn't perform well, some of the features of the contract may not be delivered. So it's important to determine your whole set of kind of what ifs. How have you already protected for disability, chronic care, long-term care, or your other insurance income? And then you have a conversation with your advisor about, to deliver that, how much of it do you need to be guaranteed versus you're willing to take the risk because you're saving enough. You're saving in your early years 10%, so you may not need as many guarantees. But if you're a 50-year-old that hasn't saved and you're just starting, and all you can save is 10%, you won't have enough to be financially independent. And so you may be interested in taking more risks. So it's an individual conversation, Portia, is the answer. And also, obviously, the more you put the insurance company on the hook, the more expensive the policy will be. Okay. Other questions? If not, we're going to soon pass it over to Shane. Any other question right now on the insurance? I don't see any. Raise your hand if you have one. Okay. So very good. I'm going to stop my share, and Shane, please take it away.
All right, here we go. Let's see how we do here with this seamless share. Hang on. View. Okay. Oh, see, I had it set up. Don't get confused here. Here we go. I had it set up on this one, but it reverted back. So good morning, everybody. My name is Shane Barnard. I am an estate planning attorney. I'm going to take us through a very topical view of what is estate planning, because we could dive so deep into all of each of these slides, but just for now, we're just going to pique some interest. And I would love to hear from you if you care to share about how many of you actually have a current plan in place or not. And if you do have a plan, how long ago did you draft it? Was it a couple of years ago? Was it 10 years ago? If you want to share, I would love to hear that from you. So like I said, quick overview. I'm going to talk about the two vehicles in which we can transfer our assets to our loved ones when we pass. One is a will, another is a trust. I'll touch briefly on taxes and gifting, and then planning for incapacity, because 1 in 10 of us will have a period of incapacity during our lifetimes. In short, the time to do estate planning is now. When there's no crisis, there's no emergency, you have not received a diagnosis that will cause stress and anxiety for us and our families, it is best to do when things are good, right? Death is not imminent. It is a way for you to document what you want, make sure your stuff goes to your loved ones, and you're not going to bring in any delay or conflict because you've already put your wishes down. You're going to name people to make medical and financial decisions for you. You can care for your pets, transfer your interest, be charitable and philanthropic if you want to, but now is the time to do it, because if you don't and something happens, that is you laying your mercy on the court and saying, hey, state of California, you decide. I trust you wholeheartedly. You have my best interest at heart, state of California. You will do it best. And the court will decide who will care for your children, who will get your stuff. And it may be those people that you wanted or not. Your crazy Uncle Larry's going to come out of the woodwork, and no disrespect if you have an Uncle Larry, just a random name I chose, but your relatives will come out of the woodwork to say they have a claim on your estate. And everything will go out to your children, if that is what the court decides, outright, without any protections. And for those of you who are in a blended family, that is a family that there's been a remarriage, a recoupling, so there are children from a previous relationship, the likelihood of disinheriting them is very high. And that is my story. That is what happened to me. I am an only child from a single mom, raised my entire life, and my mother remarried after I went off to college. She married Bob. Bob's a great guy, but she never updated her will that she had done when I was 13. So when my mother passed from Lewy body dementia, which was a very quick dementia in 2020, it all went to Bob, my stepfather. He says that I'm like a daughter to him and he has treated me as such, but guess what? On paper, I am not. So Bob said to me, I'm going to give you some money every year, and I'll talk a little bit about that. And I'll make sure you get an inheritance. Do you think Bob followed up on that word? He has not. It's now been 4 years. And guess what happened last year? My 75-year-old stepfather remarried. And so now it's all going to go to her family, and his son, unless Bob does something. But Bob has proven to me that he's not that guy. So the irony is shocking that this is what I do, but it's a lot of my why to make sure people understand that this is what happens if you don't put it in writing now. So this is a conversation that I love to have, and it's personally fueled for me with my clients. And I try to bring an awareness and an understanding of what can go wrong. So pop quiz, how many Americans do you think actually have a plan in writing right now? And this is an average. This number kind of scales up or down depending on, are we talking about the 30-year-olds, the 40-year-olds, the 50s and whatnot? But it is less than half of us, 32% of us have a plan right now. But guess what? 100% of these people ended up in probate. And when you are known by your first name, you are muy importante. Aretha had 2 wills, both handwritten. The one that was most recent or more contemporaneous with her death was found under a sofa cushion. But guess what? The people she had named in these 2 wills came to court, had to fight it out. The court had to decide which one was valid, which one was not, this, that, and the other. Millions of dollars spent on court fees on lawyers that did not go to her family or her loved ones. So we're talking Aretha Franklin, Abraham Lincoln, Michael Jackson, Sonny Bono, Jimi Hendrix, Bob Marley, Amy Winehouse, Prince, just Prince. He doesn't need a last name, right? Howard Hughes and Chadwick Boseman. And Chadwick, he had a terminal illness, so he knew he was going to pass. Did not have anything in writing, so it ended up in probate court. His wife, they came up with an agreement. His wife got half, his parents got half. So now is the time to put something in writing. Overview of wills, right? The first vehicle of how to document your wishes and transfer your assets at your death. A will is effective at your death. It goes through the court process, the probate process. It will grind through that process, which usually takes at least a year in California. And because it's only effective at your passing, you cannot plan for a period of your incapacity with a will. Some of the pros, you do get to name an executor, that person who's going to lodge your will with the court and follow that process to make sure your beneficiaries receive their inheritance. You can name guardians for your minor children. You can get that court supervision, and maybe your family would benefit from that. And you can create a trust via your will that is created at your death. Some of the cons, it is very expensive to go through the court probate process, which is public. So anyone can take a view at what's going on with your estate. It is about 5 to 8% of the fair market value of your probate assets, which I will talk about. Your beneficiaries will not receive a dime until the court gives that final stamp of approval, which can take at least a year. And like I said, you cannot plan for your incapacity with a will because it's only effective at your death. What are those assets that go through probate? Any real property, your cash accounts, your bank accounts, investments, stocks, mutual funds, and business. All of those in bold, that is what the court will look at to pass on to your beneficiaries. This is the fair market value of these assets that the court and the attorneys will take. What does not go through probate, and Jacques and Aviva, this is what you guys were kind of talking about, those named beneficiary accounts, life insurance, your 401k, your 403b, and any POD accounts, which I'll talk about, those will avoid probate. You just want to make sure that the beneficiaries you've named on those accounts are who you want it to go to. If you named your husband on your 401k and you divorced, but you never updated that to someone else, your ex-husband, if you divorce, will still get that money or that asset. Trusts, the second vehicle in which you can transfer your assets to your loved ones. It is effective during your lifetime. Therefore, you can plan for your incapacity with a trust. It does avoid probate so long as you properly fund your assets into the trust. It's private. The court does not control a trust administration. You name a trustee to do that outside of the court's overview. And this is what I recommend for most of my clients in California. A trust is a piece of paper. Simple. It is a piece of paper that is signed and notarized, and the state of California has said this has legal weight. The people or the parties to a trust are the grantor, sometimes called a trustor or settlor, the trustee, and the beneficiaries. During your lifetime, you are all these people. All of these people are vested in you. You are the person who created the trust for your benefit during your lifetime, and you also are the trustee of it. At your passing, via your trust, you name a trustee to take over when you are no longer here and to administer those assets to your intended beneficiaries. The benefits of a trust is it's private. Like I said, it does not go through court. You can plan for your own incapacity in your trust. You can protect your assets, sort of, and I'll talk about that, from lawsuits and creditors. You can create a trust for the benefit of your children, so it's staggered over ages and stages, so they do not receive a lump sum, right? inheritance, which may or may not be best for them. You can care for your pets with the trust. You can create a special needs trust if you have children or loved ones that are receiving governmental benefits due to a disability. They can still receive their inheritance in a trust and not be kicked off of those means tested benefits if it puts them into a different tax bracket, right? It's not counted towards that. And so long as the trust is properly funded, you can avoid probate. There are two different types of trusts, ones that are created at your death and ones that are created during your lifetime. And that's what I'm going to focus on, is the lifetime or living trusts. There are two types of living trusts: revocable, which is where we're going to spend our time talking, and irrevocable. Irrevocable trusts are typically used to remove an asset out of your estate, so it's not counted towards your total value of estate if you have a federal estate tax issue, which I'll touch on. It is much more complex tax and estate planning. So where we're going to spend our time today are on the revocable trusts, which is what 99.9% of my clients have. They are flexible. You can put stuff into your trust, take stuff out of your trust. You can amend it, revoke it in its entirety throughout your lifetime. So long as it's funded, it avoids probate, and you can manage those distributions to your loved ones via a trust. But because you have full control over these assets, you do not have creditor protection. You do with an irrevocable trust, which is a whole nother discussion we don't have time for on a Saturday morning. Funding, I've mentioned this a couple times. Once you have that trust, that piece of paper that is signed and notarized, now comes the work with transferring those assets into your trust or naming your trust as the pay on death beneficiary of those assets. So your home, we're going to title it or deed it into your trust. So if my home would be, instead of Shane Barnard owning the home, it will be Shane Barnard as trustee of the Shane Barnard Living Trust. I can sell the home, I can buy another home, it doesn't matter. I still have full control over those assets. Same with your bank accounts and investments. Direct transfer assets, like we spoke about briefly, those insurance policies that Jacques spoke about, life insurance, annuities, IRAs, 401ks, or other retirements. You name a beneficiary when you set up those accounts so they avoid probate, and they typically do not interface with your trust. Only those other assets will interface with your trust. Those assets that would be in your trust, you can also avoid probate by naming a beneficiary on these accounts: bank accounts, CDs, mutual funds, and brokerage accounts. And depending on your situation, you can name a person as the beneficiary or your trust as a beneficiary. And there are different reasons to do that, which we can talk about in a consultation. We don't have time for that today, but I do advise my clients, if you're not going to open a bank account in the name of the trust, make sure you have a beneficiary designation on these accounts. I talked briefly about the irrevocable trusts, and a big purpose of that is to reduce your potential federal estate tax. Right now, I call it a coupon. Each of us has a coupon of $13.6 million, which means our estate must be over $13.6 million before we are subject to a federal estate tax. How many of us are hitting that mark? Yeah, some of us, not all of us, right? Not all of us. But that federal estate tax is 40%. So we definitely don't want to pay that. But what we don't know are when we're going to pass away and what that coupon is going to be when we pass. It goes up and down depending on the administration in office. Right now, this $13.6 million coupon is what President Trump put in place. It is going to sunset no matter what, so long as no one does anything, on January 1st of 2026, down to what President Obama had put in place, which will be around $6 to $7 million, depending on inflation. We don't really know. So it's going to be cut in half. That is going to impact more of us. So the use of the irrevocable trust in taking assets out of your estate can help reduce this. All right. There's another way to reduce this if you think you might have a federal estate tax, which I'll talk about in the next slide. But I want to give a nod to portability. It is a benefit of a married couple. You can, at the death of a spouse, port that any of that unused coupon to yourself. So you could have a, $27 million coupon that you're holding, right? So you want to make sure you do that if a spouse passes away, which is horrible to think about, but this is a tax election you can do. Another way to pay down your estate is to start to give it away during your lifetime and see your beneficiaries use their inheritance instead of waiting until you pass away. As of right now in 2024, you can give $18,000 to anybody. You are welcome to give it to me, to Jacques, right? Doesn't matter, doesn't have to be a relative, and nothing different is going to change. And anything you give over that $18,000 is going to, you'll have to file a gift tax tax form, but you still can give away 13.6 million before any taxes are assessed. You're welcome to give me $18,000. I'll give you my bank account. This is what Bob said he was going to do. My stepfather, he was going to give me this amount every year. Back then, 4 years ago, it was $15,000. He just tick-tock. We're still waiting for that to show up. So there's that. Planning for incapacity, the last step here. There are 3 ways you can plan for your incapacity during your lifetime. And one is with that revocable living trust. You can name a trustee to step in during your incapacity to manage those assets, which you cannot do with a will. A durable power of attorney. You can name someone to step in to manage all of your finances during your lifetime when you have a period of incapacity due to a car accident, a surgery, or a diagnosis of dementia. This is only effective during your lifetime. It ceases to have any power at your death. Lastly, your healthcare directive. Who is going to step in and make medical decisions for you when you cannot? Do you want to donate your organs? Do you want to be kept alive on life-sustaining machines or not? These are very personal decisions that you do not want someone to have to come to court to have a court decide. Some of you may remember the case of Terry Schiavo. It was a Florida woman. She was technically brain dead. Her husband said that she wanted to be taken off machines. Her parents said she did not. There was nothing in writing. So for 7 years, it went through the court process. And finally, her husband won the decision to take her off of life support. You do not want this to be a situation in which you are having your loved ones go through. Wrap up. Any plan is better than no plan. I do advise not writing it and sticking under your sofa cushion. That's just going to be complications, right? You're going to have to prove the validity in court, but having a trust, a will, these living documents to make decisions for you and protecting your children with guardian nominations. These are important decisions that you don't want to leave up to the mercy of the court. And that is all I have for you today. We are all going to pass away. Father Time has a perfect record. Perfect. But we can do things right now to make sure that our legacy is protected and our wishes are documented. Thank you, everybody. If you have any questions, you're welcome to book a free consultation with me. I love talking about this stuff. I think probably because I didn't with my family, and now I'm motivated to really talk. If anyone has any questions, I can stop my share. And
Aviva has a question for you. Go ahead, Aviva.
Yeah.
Sorry, I always have questions.
That's not a sorry.
So I know that the priority is to have a trust, and whether just have it. That is definitely a priority. How important is it if you have adult children to talk through what you've decided already, or to talk through things before you decide, and what things should you talk to them about?
Wow, I wish my mother and I had had these conversations. What's hard is some you have to work with who you're with, right? Some parents just don't want to talk about it because it's private and it's a hard conversation. Some kids don't want to hear or face the fact that, yes, their parents are going to pass away, right? So I think treading lightly is important, reading the room is important, but having the conversation outweighs any of those sensitivities, right? It's just, you got to do it. And maybe you don't need to go into detail about everything, but just, hey, just so you know, I've drafted these documents. Here's where they are. I want everyone to know where they are. And this is generally what it says, that if something happens to me, I've already named people to step in, and this is what I would love to see happen with my legacy. I think there's no harm in that and only benefit to doing that.
I was going to add something as well.
So,
Be it adult children, adults that you're delegating responsibility in the different instruments, but be it power of attorney, healthcare directive. It's really important to communicate, one, where these documents are. A lot of times these things we keep private, and we someone didn't know that it was under the mattress or the pillow or whatever. And so in our practice, we have a digital encrypted platform that we provide as a central kind of vault, if you will, and then communicate at the required time access to this vault and platform. But also, we encourage people to have binders or put it in safe deposit box, but communicate your wishes. And interview and chat with like some tools of how to communicate that. We have some worksheets and things to help make sure you have a checklist of items that are part of the communication. So the communication is so important. And one other note on communication, I would say, is you want to make sure that the people that you're delegating want the responsibility. Just because they're loved ones doesn't mean they necessarily want to deal with the do not resuscitate or manage the distribution of assets amongst family members. They may be good at it, but do they want that role? And you want to make sure that you have contingents and people that are willing and able to take on these various roles.
yes.
Kevin, you had a question? You're muted.
I was just going to say that there are moments, having just gone through this with my mother, that kind of prompt that conversation as well, both if it's your plan or a loved one's plan as well, right? When my brother and sister passed, it was a perfect time to go in and look at what my mom had, and because I was there, so I think that to Aviva, what I would say is look for a time that makes that conversation relevant, right? To bring it together. It can be someone else passing, it can be right to where you could have that conversation and let people know.
And
I wanted to add something. Oh, go ahead, Shane. Go ahead.
I was just going to say, I agree wholeheartedly. And it can be something like, the family's going on vacation. We're going to go, and get on a flight. Like, hey, if this flight, goes down, so anything, any sort of life event like that can be kind of the spark to have that conversation. It's just, there's a lot of fear around it, right? And it's just what it is. Yep. So sorry, I think someone was piping in. Sorry to talk over you.
Yeah, that was me. So thank you, Shane, for that presentation, and Kevin, thank you for that information. Jacques, I would love to see the worksheets that you have available, because it has, for my mom. Well, first of all, I don't have a will or a trust, and I'm working on that. I think there was a quote or comment in the chat that says I've been talking about that for years. Same here. I'm going to make it happen in 2024. But having a conversation with my parent, my mother does not want to talk about that. She is a single parent, has no idea. And I'm just trying to figure out ways to gently have the conversation. Her quote unquote response is, "You and your sister know my heart." Ugh, okay. Yeah, Mom, that changes once you're gone.
Is she in California?
She's in Texas.
Okay. My dad passed with no will. The attorneys took every dollar.
Yes.
They drug it out until they knew there wasn't going to be any more money, and then they settled. So just, in California, though,
And so I don't know
there was
whether
a property out of state that was in probate, but in California it's spousal, so it all went to my stepmother.
Yeah.
Right. but the property in Nebraska, which was worth $160,000, I got like 800 bucks. So, you know, they worked it down to the penny because it's in their best interest to do it.
Yeah, just trying to get her to understand that she's old school. And
Yes.
so. there you
Yeah.
go.
So Natalie, to the old school point, if they're like any old school family member I know, they believe in cleaning up in the kitchen after dinner.
Mhm.
And this is kind of like that. You don't wait to do the dishes in the morning. You need to take care of it now.
Yes.
And it's
Right
just
on
that
time.
simple, because if you don't handle your business now, you're leaving a mess for
Yeah.
your loved ones. And, you know, we want to use the resources of the Shanes of the world, but we don't want to make an estate attorney and the legal process become the primary beneficiary because of cost and waste and delay, to Kevin's point.
Yep.
And so don't leave a mess for the family to deal with. Uh, and you may need to maybe bring it up, the passing of the next family member, a close friend. In when they're going through that experience, you say, see, they didn't wash their dishes after dinner. This is what happens. And see if she can be nudged in the right direction.
Thank you, Jacques. We do have a funeral coming up in 2 weeks, so I'm going to definitely leverage it then. Thank you.
Yep.
And I'll
There-
send you that information, Ellie. No worries.
Okay, thank you.
And the hard part, I think the last thing I want to say, you know, Kevin's story, my story, these are not, you hear these all the time, right? You hear it all the time when something can be done, but there's just so much fear and anxiety that people don't want to have these conversations. And this is the special sauce to what we do, right? Is having those special and challenging conversations.
Shane, I had a question for you. Can you talk about what is the small estate rules for, probate, that if you have an estate under a certain size, then you can simplify things?
Yes.
What would you say on that?
So I've had some clients who's like, no, I just need a will. It's okay. So I think the amount small estate value right now is $184,000. So if your estate is under that amount, it's still going to go through probate, but it's an expedited, quicker process. You know, in general, that's what it is. But my thought is, why go through court? Why would you want to go through that when you can simply avoid it by doing things a different way? But I will also say this, no matter how perfectly drafted that will is, whether it's handwritten by Aretha Franklin or laser printed by yours truly, every will is going to go through probate. Every will.
Yeah.
And so you are still stuck at the mercy of the court's efficiency, and that's a joke. It is not efficient, and you're going to pay those fees no matter what. So I, again, in California, recommend a trust.
Yeah. And I would encourage, the key is having the trust, and as Shane pointed out a couple times, funding it. I think the most common error that we see in our office is you've done the work of creating the trust, but oops, I forgot to put my home and retitle it to the trust.
Yep.
So, make sure you meet with your state attorney to go over the funding process, your financial advisor to go through your list of assets one by one, either beneficiary designation or title to the trust, and make sure you're well organized.
Absolutely. And I would second that. I was brought in after it was not my client. I came in because the son, who is the trustee of his father's trust, wanted to divvy up to the beneficiaries, and nothing was actually in the trust. So I had to go to court, and it cost them thousands of dollars to say, hey, we have a trust here. The things are listed on this trust document. See, judge. However, nothing was ever done. So, but it allowed me to go to court and say the intent of the grantor, the father, was to put it in trust. He never did. So please just say it's in trust. Don't make us go to probate. We prevailed on that motion, but we had to go to court, spend thousands of dollars to get that, which you don't want to do.
So with that, we're about top of the hour. I'm going to thank everybody for
Portia,
participating.
no, sorry. Portia just dropped no, you do not have to refinance a home when you put it into trust. You don't. It just slides right in
Common
there.
question. Yep. Very good question.
Yep.
So thank you for joining us. Stay on if you have more questions, but we'll end the recording here. This is protecting your loved ones.